Welcome to our in-depth guide on common terms used in the stock market and investing. Understanding these terms is essential for navigating the world of finance. Let's dive in. Stock. A stock represents ownership in a company. When you purchase a stock, you become a shareholder, which means you own a piece of that company. Stocks are traded on exchanges and their prices fluctuate based on supply and demand. If you buy shares of Apple Inc., you own a small part of Apple and can benefit from its growth through capital appreciation and dividends. Dividend. A dividend is a portion of a company's earnings distributed to its shareholders, usually in cash or additional shares. Dividends are typically paid quarterly and are a way for companies to reward their investors. For instance, if you own 100 shares of Coca-Cola and they declare a dividend of 40 cents per share, you would receive $40. Market capitalization or market cap. Market capitalization or market cap is the total market value of a company's outstanding shares. It's calculated by multiplying the stock price by the number of shares outstanding. If a company has 1 million shares outstanding priced at $50 each, its market cap would be $50 million. A bull market refers to a period of rising stock prices, typically characterized by investor optimism and strong economic indicators. It generally occurs when the market rises by 20% or more from its recent lows. The stock market experienced a bull market from 2009 to 2020, where major indices reached all-time highs. In contrast, a bear market is a period when stock prices decline by 20% or more from their recent highs. This often reflects widespread pessimism among investors. The bear market during the COVID-19 pandemic in early 2020 saw major indices fall sharply before recovering. A portfolio is a collection of financial assets such as stocks, bonds, and other investments owned by an individual or institution. Diversification within a portfolio can reduce risk. An investor might have a portfolio that includes stocks from technology, healthcare, and consumer goods sectors to spread risk. Asset allocation refers to how an investor distributes their investments across various asset classes such as stocks, bonds, and real estate. This strategy is crucial for balancing risk and return. A common asset allocation strategy for a balanced portfolio might be 60% stocks and 40% bonds. Equity represents ownership in a company, typically through common or preferred stock. Equity holders may receive dividends and have voting rights, depending on the type of stock. Investing in equity allows you to participate in a company's growth and profitability. An initial public offering, or IPO, is the first sale of a company's stock to the public. Companies go public to raise capital for expansion. When Uber went public in May 2019, it offered shares to investors for the first time, marking its transition from a private to a public company. Price-to-earnings ratio, PE ratio. The price-to-earnings ratio, or PE ratio, is a valuation metric that compares a company's current share price to its earnings per share, also known as EPS. It helps investors assess whether a stock is overvalued or undervalued. For example, if a company has a share price of $100 and earnings of $5 per share, its PE ratio is 20. A higher PE may suggest growth expectations, while a lower PE may indicate undervaluation. Earnings per share, EPS. Earnings per share, or EPS, measures a company's profitability on a per-share basis. It's calculated by dividing net income by the number of outstanding shares. For example, if a company earns $1 million and has 1 million shares outstanding, its EPS is $1. Investors often look for companies with increasing EPS as a sign of growth. Market order. A market order is a request to buy or sell a stock at the current market price. This type of order is executed immediately, but the price may vary slightly due to market fluctuations. For example, if you place a market order to buy shares of Google, your order will be filled at the best available price at that moment. 13. Limit order. A limit order specifies the maximum price you're willing to pay when buying or the minimum price you'll accept when selling. This allows for more control over trade prices. For example, if you place a limit order to buy Apple shares at $150, your order will only execute if the price drops to that level or lower. (14) Stop-loss order. A stop-loss order is designed to limit an investor's loss on a position by automatically selling the stock when it reaches a predetermined price. For instance, if you own shares of Tesla at $700 and set a stop-loss order at $650, the stock will automatically sell if the price falls to $650, protecting your investment from further loss. 15. Volatility. Volatility refers to the degree of variation in a trading price series over time. High volatility means a stock's price can change dramatically in a short period. For example, technology stocks often exhibit high volatility, with prices swinging widely based on news and market sentiment. Bearish and bullish are terms used to describe market sentiment. A bullish market indicates optimism and rising prices, while a bearish market reflects pessimism and falling prices. For example, if analysts predict a downturn in the economy, they might say the market is bearish. Blue chip stocks are shares of well-established financially sound companies with a history of reliable performance. These stocks are considered safer investments. For instance, companies like Johnson & Johnson and Procter & Gamble are examples of blue chip stocks known for their stability and dividends. A sector is a distinct part of the economy where businesses share similar characteristics or products. Common sectors include technology, healthcare, and finance. For example, investors often diversify their portfolios across various sectors to reduce risk. (19) Short selling. Short selling is an investment strategy that involves borrowing shares to sell at the current market price, hoping to buy them back later at a lower price. For example, if you short sell a stock at $100 and it drops to $70, you can buy back the shares, returning them to the lender and profiting $30 per share. (20) Margin. Margin refers to the money borrowed from a broker to purchase securities. Investors use margin to leverage their investments, potentially increasing returns but also risk. For instance, if you have $1,000 and your broker offers 50% margin, you can purchase $2,000 worth of stock, amplifying both gains and losses. (21) Index. An index is a statistical measure that reflects the performance of a specific group of stocks. Common indices include the S&P 500, Dow Jones Industrial Average, and Nasdaq. For example, the S&P 500 tracks the performance of 500 of the largest US companies, serving as a benchmark for the overall market. (22) Recession. A recession is a significant decline in economic activity lasting more than a few months, often reflected by falling GDP, rising unemployment, and declining consumer spending. The Great Recession from 2007 to 2009 was marked by a housing market collapse and widespread unemployment. (23) Inflation. Inflation is the rate at which the general level of prices for goods and services rises, eroding purchasing power. Central banks often aim to control inflation through monetary policy. When inflation rises, the purchasing power of your money decreases, meaning you can buy less with the same amount. (24) Liquidity. Liquidity refers to how easily an asset can be converted into cash without affecting its market price. Cash is the most liquid asset, while real estate is less liquid. Stocks of large companies like Apple are considered liquid because they can be quickly bought or sold on the market. Arbitrage is the practice of taking advantage of price differences in different markets to earn a profit. Traders buy low in one market and sell high in another. For example, if gold is priced lower in one country than another, an arbitrageur might buy gold in the cheaper market and sell it where prices are higher. A hedge fund is an investment fund that employs various strategies to generate high returns for its investors, often including both long and short positions. For example, hedge funds may use leverage and derivatives, aiming for higher risk-adjusted returns compared to traditional mutual funds. A mutual fund is a pooled investment vehicle that collects money from multiple investors to purchase a diversified portfolio of stocks, bonds, or other securities. For example, investors can buy shares in a mutual fund that focuses on technology stocks, gaining exposure to multiple companies in that sector. Exchange Traded Fund, or ETF. An ETF is similar to a mutual fund but trades on stock exchanges like individual stocks. ETFs offer diversification and usually have lower fees than mutual funds. For example, an investor can buy an ETF that tracks the S&P 500, gaining exposure to all the companies in that index. Futures contract. A futures contract is a legal agreement to buy or sell an asset at a predetermined price at a specified future date. These contracts are commonly used for commodities and financial instruments. For instance, a farmer might sell a futures contract for wheat at $5 per bushel, ensuring a set price regardless of market fluctuations at harvest time. Yield. Yield is the income generated by an investment, expressed as a percentage of the investment's cost. It's commonly associated with dividends and interest payments. For example, if a stock pays a $2 dividend and its current price is $50, the yield is 4%. Investment grade refers to bonds rated by credit agencies as having a low risk of default. These ratings help investors assess the credit quality of bonds. Bonds rated BBB or higher by agencies like S&P are considered investment grade, making them attractive to conservative investors. Penny stocks are low-priced stocks, often trading for less than $5 per share. They are known for high volatility and risk, but can offer significant upside potential. Investors often buy penny stocks in the hopes that a small company will grow rapidly, though these investments come with higher risks. Over-the-counter trading involves stocks not listed on major exchanges. OTC stocks are often less regulated and can carry higher risks. Many small or emerging companies trade OTC, providing opportunities for investors willing to take on more risk. Green investing. Green investing focuses on companies that prioritize environmental sustainability. This trend has gained traction as investors seek to align their portfolios with their values. Investing in renewable energy companies like solar or wind power is an example of green investing. Value stock. A value stock is a company's stock that is trading at a lower price relative to its fundamentals, such as earnings or dividends. These stocks are often seen as undervalued. If a company has strong fundamentals but its stock price has dropped significantly, it may be considered a value stock and a potential buy. Growth stock. Growth stocks are shares in companies expected to grow at an above-average rate compared to their industry. These companies often reinvest earnings rather than paying dividends. Tech companies like Amazon and Netflix are often categorized as growth stocks due to their rapid expansion. Quantitative easing is a monetary policy used by central banks to stimulate the economy by increasing the money supply. This often involves buying government securities. During the 2008 financial crisis, the Federal Reserve implemented QE to lower interest rates and encourage borrowing. Securities and Exchange Commission, or SEC. The Securities and Exchange Commission, or SEC, is a US government agency responsible for regulating the securities industry and protecting investors. The SEC enforces laws against insider trading, ensuring a fair and efficient market. Fiscal policy. Fiscal policy refers to government spending and tax policies designed to influence the economy. It can impact inflation, unemployment, and overall economic growth. Increasing government spending during a recession is an example of expansionary fiscal policy aimed at boosting economic activity. Monetary policy. Monetary policy involves controlling the money supply and interest rates by a central bank to achieve economic objectives like controlling inflation and promoting employment. The Federal Reserve may lower interest rates to stimulate borrowing and spending during an economic downturn. And there you have it. Understanding these common terms is crucial for anyone looking to navigate the world of investing and the stock market. Remember, knowledge is power. If you found this video helpful, like and subscribe for more insights into the world of finance.